Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So today we are back in the green again. So the market is just open just today. As you can see, we're around here. I've added a little bit of money. That's probably one of the reasons. I haven't actually bought anything with it yet. It's still sitting there. Okay, that £400 I was basically planning to invest this week is just sitting there. But as you can see right now, is actually not bad. Okay, it's gone back green again just today. And by looking at this, right, so this is what we used to almost for 2 years in a row. And then all of a sudden, if we change this to 6 months, this is what we've seen in the last few months. Okay, and right now, you know what, this, although today is a great day and the markets are up, they could be all red by the end of the day. So it's just one of those situations where the markets are really volatile because of everything that's going on. But as long-term investors, do we really care? No. The red days are actually a great opportunity for us to actually add to our portfolios. And right now, the markets has actually given us so much opportunities, because when you look at just the last 6 months and you see this, okay, there's so many opportunities here. Okay, if you're a long-term investor, you should be happy the fact that actually markets actually came back down to earth, because not long ago we were looking at the markets and we couldn't find anything that is on sale, anything that's undervalued, anything that we think that will be a long-term investment. Okay, so for that reason, today we will be looking at 10 different companies that are called the Dividend Aristocrats. Dividend Aristocrats are companies that have paid and increased dividends for 25 years or more. These companies are they have to be in the S&P 500. They have to basically increase their dividend for 25 years in a row. Now, the reason I would like to focus on these companies is because they're companies that are really, they have cash, and then they share that cash with us. And that's what we want, especially if we end up in a bear markets where we're not going to see our stocks going up 20%, 30% every single year. We need some sort of a cash. You need some sort of return on your investment. So what you end up getting is a nice dividend, okay, and then you reinvest that money. So if I show you my dividends, okay, since I started this portfolio, as you can see here, I have been paid £1,149.30. Right, that is the money I didn't have to do it. I didn't have to do anything. Okay, I have a rental property. If anything goes wrong, basically you have to take care of this, the tenant, and make sure everything is perfect. Whereas here, I don't really have to do much to actually earn that money, other than buy quality companies that will increase their dividends, okay, year in year out. And when you look at these companies, Home Depot recently paid me £16. Unilever, again, another £16. 3M, £26. Pfizer, okay, PPG there, S&P Global, Microsoft, Bank, you name it. Every single of these companies are paying me dividend every single month. And I absolutely love the dividend side of it. And when you look at the general markets and you see the S&P 500 down 21% a year to date, then you look at the Dow Jones down basically 16%, or almost 17%. And then you look at the QQQ, or which is basically tracks the NASDAQ, you can see is almost 30%. So there are opportunities out there for us. So what we need to do is look at these companies and see if they are actually worth investing. And maybe I love dividends, okay, and I love the cash flow, and that's definitely something I'm going to continue investing in. But obviously I do like growth companies as well, especially with the tech companies, okay, the ones that I understand the business model. If I understand their business model and they are in the tech companies, okay, then I'll most likely put some money in. And I've got like Salesforce and Adobe's and so on. But dividends are really the future right now, especially in the situations that we're in. So we've got 10 different companies. So let's have a look at the companies. But before I do that, please like the video. Just click that like button, click the subscribe button, whatever you need to do just to help the channel. That will be appreciated. Thank you. So I put together 10 companies. As you can see here, what we're doing is we've got the ticker, the company, the sector, we've got the yield, the dividend yield, we've got 5-year growth rate. Okay, we've got the payout ratio, we've got years in dividend increases, so how long they have increased the dividends. So we've got safety from Morningstar, so percentage 99 is the highest. We've got the profit margins. We're looking for anything above 15, 10, whatever in that range, which is really good. place to be in. Free cash flow, that covers definitely the dividend and hopefully can help the company to reinvest and so on. We're looking at total returns over the last 10 years. Okay, that includes dividends as well as the price appreciation. We're looking at the next 5 years where the company is going to be every single year in the next 5 years. Okay, basically in terms of earnings wise. We're looking also at the Morningstar valuations. Morningstar, the company that I use a lot, and I feel like they're reliable, and obviously I feel like they are quite, in terms of margin safety, I think they're quite strict in terms of the evaluations. Okay, and then we're looking at fair values. Okay, so let's have a look at the first company in this list, and that is AbbVie. AbbVie is a company that I haven't spoken about a lot for a long time because it is actually overvalued at the moment, as you can see. Is in the healthcare, it has a 4% yield. Okay, I believe they pay about almost, let me double check in fact how much in terms of dividend wise. I think they pay, so give me 1 second. Yeah, they pay over $5 per share, so the $5.64 for every share that you own, about 4% yield right now. The 5-year growth rate is 18%, payout ratio only 42. This is important. Why? Because if a company is spending a lot of remember, the company is giving you some of their money, and you want to know what percentage of their earnings, okay, they basically giving to you as a shareholder. Right now it's only 42%, so they have a room to grow that dividends, also room to reinvest and so on. Okay, so they're not giving every penny. Some companies will be almost 99-100%. Some companies will borrow actually money from the bank to pay you. You don't want those companies. Okay, in terms of growth in the last last 50 years, they have been increasing this dividend. So this is actually a dividend king. Safety 70%. Profit margin 22%, free cash flow of $22 billion, and the last 10 years this company has returned, last 5 years, sorry, this company has returned 21. Why? Because this is a split from an Abbott laboratory, so they haven't been around for 10 years. But because of this split, that they are still part of that company, and they have inherited in a way basically the Dividend Aristocrat and Dividend King status. Okay, growth in next couple of years, basically next 5 years, they expect 2% every single year. Again, this is like a steady eddy company. Obviously they're not going to grow that fast right now. I'm sure in the next few years they might have a new patent, new drugs, whatever, but right now it's only 2%. As you can see, it's 15% overvalued. The price should be 127. The next company that we're looking at is the Abbott Laboratories, the company that actually AbbVie split from. Okay, again, the same thing, but they have 1.83 dividend yield, 12% of 5-year growth rate, 12%. Payout ratio is quite low, actually lower than AbbVie, which is good. Again, 50, 71, profit margin about 17%. Free cash flow here, they've got about $8 billion, and total returns over the last 10 years, we're looking about 10%. And it's right now fair, basically, next 5 years, they're expecting 12% growth in terms of their earnings. Now, Morningstar is actually saying it's fairly valued at the moment, and the price should be $104 per share. Next company we're looking at is SPGI. This is a company that I've spoken about for a long time. It's in the financials. They do a lot of the credit controls, credit ratings and all that stuff. Their dividend yield is not great, 1.06, but 5-year growth rate about 16%, and a payout that's really, really low. But they have been increasing their dividend over 48 years. So they have room to grow that dividend, definitely, and it's definitely safe. They've got profit margins of about 40%, free cash flow about $3 billion in the bank, and basically total returns over the last 10 years is about 14%. Now, next 5 years, they're expecting 12% growth and in terms of earnings, and then 22% discounted at the moment. The price should be $410 per share. The next company, we are looking at A.O. Smith Corporation. This is an industrial company. They have a 2% dividend. In terms of 5-year growth rate, they have about 17%. Payout ratio 34 years. In dividend increase is 28 years, and as you can see, is definitely safe. Almost 14% in terms of profit margins, and they have $482 million in the bank to pay off that dividend, or to cover that dividend. Total returns over the last 10 years is actually quite good for an old company. And then when you look at the next 5 years, they're expecting 8% growth. Right now is actually basically discounted and $68 per share. That's what they're expecting to the price to be in the next 5 years, and sorry, this by the end of this year. So Lowe's, that's the intrinsic value. Okay, so Lowe's currently is trading, I think, about 172 or so, but as you can see, they're expecting the price to be $209 per share. This is a company I own in my portfolio. I've spoken about it a lot. You can see it used to be the yield, trust me, it was about 1 point something. Right now 2.44, because obviously the stock went down quite a bit. In terms of 5-year growth, in terms of dividend, look at that. Compounding growth rate of about 18%, which is really nice. Payout ratio only 26, and they have increased this dividend for almost 60 years. Okay, dividend safety of 93. This dividend is not going anywhere, and this is the type of companies that you want to invest in, because they're not going to cut that dividend because they're actually proud of it. At the same time, they have enough cash. They create enough cash, enough revenue to cover that basically dividend. And at the same time, if we get into a bear market and the stock doesn't go up, but your dividend stays the same or even better, okay, they keep increasing every single year. Even if it stayed the same, you're still getting 2.44%, okay, of your money, which is really nice. And the total return of the last 10 years, if you look at it, basically you're looking at about 23% almost. For the next 5 years, they expect about 15% growth. Even if it grows about 10%, that's amazing. And right now it's discounted about 17%. So Lowe's is one of the companies I definitely own in my portfolio. Great company, absolutely love it. The next one, Illinois Toolworks, is an industrial company, 2.74% dividend yield, 14% 5 years growth, payout ratio about 60%, and then they have increased this dividend almost to 50 years. Safety really good, 81%, profit margin 18%, free cash flow almost $2 billion, and they have actually total return given away basically almost 16% total returns over the last 10 years. Next 5 years, we're expecting about 11% growth, and right now it's discounted. The price should be about $205 according to Morningstar. So again, another great company. As you can see, their dividends is actually nice, 2.74. There is enough free cash flow, and they are discounted at the moment. So again, that's another bargain, another company that you could potentially look into. I'm just giving you a quick overview of all of these companies, but hopefully then you can go away and do a little bit more research and find out the details, what they sell, who they sell it to, who's their biggest customer, what the projections are for the next few years. Look at the revenue, look at the cash flow, look at the EBITDA, look at all the stuff that we talk about all the time, okay, because that's really important. Right now, the next company we're looking at is Automatic Data Processing. This is basically, again, information technology company, 2% dividend, 5-year growth rate of 12%, payout ratio just about 60%, and then they have increased this dividend for 46 years in a row. Safety is perfect, 97, almost 18% profit margin, free cash flow $2.3 billion, total return over the last 10 years 17%, and 5-year growth rate about 15% next 5 years, fairly valued at the moment $228 per share. Okay, again, another great company. It's been around for a long time. Do your research, find out if it's actually worth. Okay, I always get confused between these two tickers, ADP and APD. And the next one is Air Products and Chemicals, a company that I own in my portfolio. Is in materials, gases, and so on. 2.75% of dividend yield, 11% of 5-year growth rate of 11%. Payout ratio is only 63, and they have increased this dividend 39 years in a row. Safety is perfect. Profit margin is really good. And free cash flow is not as much as I would have liked, but almost the 400 million that covers the dividend. Okay, and hopefully the company will not get into any trouble to the point where they can't pay that dividend. Okay, but right now the way things look, I'm not worried about it. I'm happy to keep it in my portfolio. Total returns of the last 10 years, we're looking about 14%, and the next 5 years they're expecting about 12%. Right now it's discounted 26%, $317 per share is the expected price, okay, for this company. The next one we are looking at is Robot Technologies. This is the company I need to do a little bit more detail, basically thorough analysis. I genuinely like their business model, so I'm going to do a little bit more. It kind of reminds me Emerson Electric, but I want to find out a bit more about this company. Their dividends is not great. It's 0.66, and then 13% or 5-year growth rate, which is really good. Payout ratio very, very small. 5-year growth rate over 29. So they just became Dividend Aristocrat about 4 years ago. Dividend safety of 98%, profit margin, as you can see, 48%. This is one of the reasons I want to do a little bit more research in this company. They have enough cash, $1.8 billion in the bank, and they've returned about 16% to shareholders over the last 10 years. And next 5 years, expected earnings growth is about 8%, and right now discounted about 27%. 510 basically per share. That's what they're expecting, and over Morningstar. The next one is Church and Dwight. This company is a consumer staples. Right now is 1.28 dividend yield, 7% off in terms of growth wise. So it's the lowest out of all of these companies, because one of the things that the Dividend Aristocrats do is they increase that dividend obviously quite substantially every single year, especially where you know the company is still in the growth stage. Because if you companies like Lowe's, they have been around for a while, but they still increasing that dividend, and that's what you want to see. 34%. So that's not bad. So hopefully in the next 5 years, whatever, this company should be, you know, increasing that dividend. 5-year growth rate, dividend years in dividend increases. That's about 29 years in a row. Safety perfect. Profit margins above 15, which is what we're looking for. They've got almost, you know, $938 million. Okay, that's in a million. Okay, of free cash flow right now. That covers enough dividend. But again, when I say a million, I'm always like, it will be better if it was in the billions. Okay, because you want to always have you know, that margin of safety. But the fact that this company was given 98% and this company was given 99%, this one was given 95%. That gives me a reassurance that they're not going to cut, you know, they're not going to cut that dividends anytime soon. So 13%, almost 14% total returns over the last 10 years. And the next 5 years, they expect about 7% growth every single year. Right now is 42% premium. Okay, that is quite expensive. So I wouldn't go anywhere near that company right now. I would look at the ones that are undervalued and do a little bit more research, find out what they do, how they make their money, okay, what their projections are. Like I said, look at their financials, look at their 10Ks for the last couple of years, get feel of the company. Then once you're happy with that, put your money into it. Because right now, there's a lot of people telling us, you know, don't invest in the stock market, it's a crazy place, whatever. But when you look at these companies, a company that has increased their dividend 50 years, you know what that takes, right? So companies like SPG or Global, S&P Global, right? 48 years of increasing that dividend. What happened in the last 48 years? I'm sure we had recessions. I'm sure we had high inflations. I'm sure there was a war going on at some point. I'm sure there was other things happening. Okay, I'm sure there was a housing bubble and all sorts of things that okay. There was a tech bubble, you know, the dot-com bubble. All of that happened in the last 48 years, right? And what happened? This company continued to increase their dividend. And that's the point I want to make, guys. This is the beauty about investing in dividend stocks, because of that stability, because the fact that you're going to get paid, it doesn't matter what's going on. Some of them, unfortunately, will cut their dividends. And that's why we focus on these things. We don't just look at these things because we want it or because we think, oh, let's have a look at the safety. We look at it because we want to make sure the company that we're investing in has actually future, and hopefully they will not cut that dividend. Because sometimes you invest in a company because of the dividends, because you want that income. But it's a good company and you think, actually, you know, Lowe's is not great, but you know, bad business. Okay, S&P Global is not a bad business. ADV is not a bad business. Okay, Air Products and Chemicals, and I want to put a little bit of money to. Okay, how is their safety like? Okay, they're very safe. Then put some money, and then you get that cash every single month. So it is really important. I'm trying to make the point that dividends are very important, especially in a recession time where, you know, bear market. And that time you might not get any price appreciation, but you get paid. Okay, and that's the bit that I want to tell you about. And I do own quite a few of these companies. Okay, I own Air Products and Chemicals in my portfolio. I do own Lowe's somewhere. There you go. I own Lowe's there. I own, what other companies have we talked about that I own in my portfolio? S&P Global. I only have 2 shares, so I'm definitely going to add to that. Okay, so these are the type of companies that you should be looking at hopefully in the long run. If you enjoyed the video, please like, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.